In Chapter 14, we examined the individual tax formula, starting with the different filing statuses, moving to the computation of taxable income, and finally, computing the taxable liability based on that taxable income. In this unit, we look at sole proprietorships, which can provide an additional source of income to a taxpayer. In this video, we'll look at the proprietorship, and we'll also look at what additional taxes are required for self-employed individuals. This is part of the Form 1040, page 2. In Unit 14, we computed the individual tax liability, starting with the income from all sources, deducting the exclusions from or adjustments to income, deducting the standardized or itemized deduction as the case may be, and finally, if applicable, deducting the qualified business deduction. Those 4 items, when combined, get us taxable income, which we would then multiply by the tax rate to compute our tax liability. In this chapter, we're addressing 2 components of the tax return. The first 2 items, when grouped, relate to proprietorship income, which is an additional source of income that must be added to your individual tax return. We'll also talk about the Section 199 deduction for qualified business income and how that offsets the income earned from a proprietorship. Finally, since most proprietors are self-employed, we'll look at how this impacts the federal income tax withholdings as well as the tax owed. A sole proprietorship is an unincorporated business activity owned by one individual. It can also be owned by a couple and still be considered a sole proprietorship. The sole proprietor owns the business assets in his or her own name and is personally liable for the business debts. Schedule C of Form 1040 is used to report profit or loss from a business operation. Part 1 includes the revenue from all sources of proprietorship income, net of the cost of goods sold, and returns if it's a selling business. Part 2 is effectively the expense portion of an income statement, summarizing the operating expense as well as cost recovery deductions or depreciation relevant to the business. The net profit or loss is computed by subtracting the expenses from gross income. Any business income must be reported on the income statement on 1040. Because sole proprietors are generally small business owners and often startups, the tax code provides for a home office deduction that a sole proprietor can take if their home office meets several requirements. First, the proprietor must exclusively use the home office as a place of business on a regular basis. This means that the proprietor uses the home office to meet with patients, clients, and customers, or if the proprietor uses the space for administrative activities alone, this means that the proprietor does not regularly use another office space. For example, a doctor that has affiliation at multiple hospitals may never set foot in a hospital office, but instead use his or her home office to complete files for patients and to handle all of the administrative needs, such as billing for insurance. Finally, the amount of the deduction must be less than the proprietor's taxable income. That is, you can't use your home office deduction to eradicate all of your small business income. So let's check your comprehension of the home office rule by assuming that Phoebe Buffet writes songs and handles the administrative tasks of booking gigs, of booking her accounting entries, and of contacting studios exclusively from her home office. Rent on her apartment runs her $48,000 annually. Her housekeeping expense is $5,200, and her renter's insurance is $2,400. She uses 300 of the apartment's 900 square feet for her home office. How much can she deduct if she earns $300,000 as a singer-songwriter? First, we need to compute the annual rent expense related to the apartment. This would be the equivalent of leasing an actual office space if she had a designated office space outside of her apartment. So to figure that out, we take the total expenses related to her apartment and figure out which portion is attributable to her home office. Apartment expenses include her rent, her housekeeping, and her renter's insurance. Together, these equal $55,600. She uses 300 out of 900 square feet, or 1/3, for her home office. Which gives her a home office expense of $18,533. Can she deduct that whole amount? The answer is yes, because her income as a singer-songwriter exceeds it. The limitation of this expense is that Phoebe can't deduct more than she actually earned. And you can see that Smelly Cat did Phoebe well this year. Now that we've talked generally about the revenues from a proprietorship and the expenses of a proprietorship, as well as one of the special provisions for home business offices within a proprietorship, let's talk about another provision that's a Tax Cuts and Job Creation Act of 2017 provided for sole proprietors. This provision allows proprietors to deduct 20% of their qualified business income before arriving at their total taxable income. What this effectively does is move small business owners from one tax bracket or marginal rate to a lower one. This amount is limited. It cannot exceed 50% of the W-2 wages or 2.5% of the unadjusted basis of qualified business property plus 25% of W-2 wages. These two exclusions help to protect small business interests and exclude large sole proprietorships from taking advantage of this deduction. Now let's talk briefly about payroll and employment taxes, a tax that an entrepreneur would have to pay on behalf of his or her employees. Any proprietor who employs others must obtain an employer identification number and comply with state and federal taxation requirements. For an employer, this broadly includes unemployment tax, which is a portion of employee wages, the FICA tax, known more informally as Social Security and Medicare, as well as withholding income taxes from employee salaries. Each of these are remitted to the IRS. The unemployment tax is strictly paid by the employer, whereas the FICA tax has an employee contribution and an employer contribution. For employers, Social Security is equal to 6.2% of an employee's first $128,400 of gross wages. The Medicare portion of the tax for employers is 1.45% of the total employee payroll. The 6.2% percentage is the same for employees, but the Medicare portion is a little bit different. For any single employee earning more than $200,000, married employees earning more than $250,000, or a married person filing separately earning $125,000 or more, there's an additional 0.9% tax, which was a component of the Health Care Act passed under the Obama administration. So let's check your comprehension of these payroll taxes by looking at Rachel Green's salary under a few different assumptions. We're looking at it from the employee's perspective because, for the most part, the employer percentage is just matched, whatever is paid to the employee. In the first scenario, Rachel earns $60,000 in her position. What would be the tax deducted from her paycheck? If Rachel earns $60,000 annually, this places her below the $128,400 Social Security base income and well below the $200,000 additional Medicare base. So this means her Social Security and Medicare contribution is 7.65% of her $60,000 wage, which is $4,590. Now let's compute her wage if she earns $200,000 annually in her position as a buyer. In the second scenario, if Rachel earns $200,000, this puts her above the Social Security base of $128,400. Accordingly, only that $128,400 base is taxable. So the Social Security portion of her tax is $7,960. Now, the whole balance of Rachel's Medicare tax is taxable at 1.45% of her gross salary of $200,000. This means that the Medicare portion of her salary is $2,900. So now, if Rachel earns $25,000 annually in her position, she's also subject to the additional Medicare tax. This would only cover her additional $25,000 of income, and that would be 0.9% of that. If Rachel earns $225,000, her additional Medicare contribution would then be $225. Since sole proprietors are self-employed, they must pay both the employer's portion of the payroll tax that would be deducted, as well as the portion of the payroll tax that would be withheld from the employee's salary. Since for a sole proprietorship, the income of the company is the same as the income that passes through to the owner, this means that there's an overlap here of 7.65%. So, in computing the self-employment tax, you have to adjust that total salary or the total pass-through amount by 1 minus 0.0765, or multiply the total business income by 92.35%. If this amount is greater than $128,400, the employee pays both halves of the Social Security tax. Regardless of the amount of the adjusted income, the employee pays 2.9% of the Medicare portion of tax. And if this pass-through income is greater than the Medicare withholding threshold that was passed under Obamacare, they're also subject to the 0.9% additional medical care tax. So let's try this one out for size by computing the payroll taxes for Joey Tribbiani, assuming he is self-employed. That is, that Days of Our Lives pays him as a contractor. Let's figure out the Social Security owed, as well as the medical care liability owed, if Joey's annual salary was $350,000. So we can start by computing what 92.35% of Joey Inc.'s income that would then pass to Joey. This adjusted amount is $323,000 plus some change. Since this amount is greater than $128,400, which is the Medicare base, we know at a starting point that Joey owes 12.4% of the Social Security base, which is equal to $15,922. Now let's look at the Medicare portion. Joey owes 2.9% of the adjusted revenue plus 0.9% of this adjusted amount above the $200,000 individual additional tax. This means that Joey owes around $9,400 for his self-employed normal Medicare contribution, as well as $1,100 of this additional Medicare liability above $200,000, for a grand total of $26,405 for his Medicare liability. Now, before we move on from Mr. Tribbiani and his tax liability, we should look at one more thing on the Schedule SE, and that's this line 6 here, the deduction for 1/2 of the self-employment tax. The tax law recognizes that it's really not fair to make a business person pay for both halves of something that his employer would generally pay just because he or she works for himself. So, the very bottom line of this schedule deducts half of the employment tax. We previously computed Joey's tax liability to be $26,405. To figure out what Joey's self-employment tax would be, we need to figure out first the deduction that he would take, which requires multiplying this number by 1/2, which would give us $13,202 for a deduction. This adjustment amount is considered when determining Joey's overall tax liability for his personal income tax return. In this unit, we covered the self-employment and sole proprietorship income that gets reported on Schedule C and Schedule SE of Form 1040. In Chapter 17, we examined the treatment of personal income and expense items under the tax code. As we finish up our unit on individual taxation, we'll examine how investing, payroll, and retirement decisions impact our overall tax liability.